Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started, any advice provided by Brandon is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. Brandon Kolk is authorized to provide general financial product advice in Australia and is authorized representative number 1305795 of Guideway Financial Services Proprietary Limited, AFSL number 420367. Please see the description box for Brandon's financial services guide. Past performance is not a reliable indication of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast.
Hey everyone, welcome back to yet another episode. Hamish, how you doing, mate?
Hello. I'm doing well. Yeah, much better than last week. So yeah, I'm happy. How you doing?
Wait, you're feeling good?
Yeah, I'm feeling better. I know. So I
Wow.
know, shocker, right? Yeah, we're just gonna we'll just take this week and appreciate it. And,
actually,
we'll see if it follows through into next week.
I am glad you're feeling better. I'm definitely glad you're feeling
me too.
better. What you been up to?
Not much. Just getting back in the video. It's as I said last week, just so good to just be back, like doing stuff. So put out a video earlier in the week, and got
Nice.
a couple others cooking. That's the thing. It's like I couldn't post content while I was sick, but I had a lot of ideas come up, and I've got like a lot of like the bones of videos that I'm going to be making over the next few weeks. So it's kind of been nice in a way because I've got all these like ideas and things that I can do. It's like I'm not really starved too much for ideas, although there's nothing kind of major going on in finance at the moment, but kind of scrapping together what you can.
Yeah, it's just kind of just plodding along, isn't it? Yeah, not a lot's going on. Although there has been some stuff over the past week or so, which we will get to.
Yes.
You're what are you? What?
You're doing some kind of speaking event coming up, aren't you?
Oh yeah. So that's I got invited to go onto a panel and speak at South by Southwest. So this is a thing that I think originates in Texas, and they're bringing it to Sydney. So this is the first time it's happening in Sydney. Yeah. And I'm very fortunate that I get to join a panel and be a speaker at South by Southwest. Yeah, I can tell you guys because I don't know the exact details. So I will be on stage on Friday the 20th of October at 12:30 p.m. And it's at the Convention Centre in Sydney, and it's room E3.9.
And you're announcing your new NFT project, right? That's what it is?
Correct. Right? Yeah, it's essentially a sales pitch for what I've done is I've opened up Photoshop, and I've got Claude and the boys to each come up with a different design of a monkey, and I'm going to be selling the monkeys as NFTs. Yeah,
very original. So, hasn't been done before.
I know. I don't think anyone's done that before. So
you should like connect it to some kind of club, like so when you get the NFT, you can like attend like a bunch of like events, maybe like yacht clubs. That I don't know. I'm just
that's
spitballing.
A good idea. Yeah, that's a very good idea, Hamish. So obviously I'm revolutionary in the field of NFTs. So if you want to come listen to my lecture, no, but actually we're talking about business building and working towards early retirement in a challenging environment, basically. So that's what we're going to be talking about.
Interesting.
Which should be cool. But super excited to get the opportunity. I don't know too much about South by Southwest, but hoping it'll be cool. I think it's all up in the air because it's the first time it's done in Sydney. But should be fun, I think.
Yeah, maybe I'll fly
we'll
up.
See.
Maybe I'll come. Maybe I'll sit in the audience. Is there a Q&A? Can I raise my hand?
Yeah, put your hand up.
Mr. Vanderkolk.
Mr. Vanderkolk.
I have a question. Throw you some absolute curveball.
Absolute. Yeah. Just like get into the absolute depths and the weeds of some financial statement and just be like, so Brandon, what do you think? Should I buy X, Y, or Z stock? Yeah. Anyway, what are we talking about today, Hamish? What are we talking about?
There's been a few interesting kind of developments over the past week. We've Mr. Bill Ackman is back in the news because he has a new investment product for us. He's always cooking up something special.
He is,
so
isn't he?
he's always looking for some way to scam his invest. No, not to scam his investors. He's got a new investment product for us that we'll talk about. Sam Bankman-Fried's trial began a couple of days ago, so I'll kind of talk through maybe some of the things.
Talking about scamming investors.
Yeah, exactly. It's all scammers. Ones that haven't gone to jail yet, some that are on trial. Yeah. Bill Ackman's not a scammer. Okay, he's not a scammer. I don't know why I made that.
He does have a bit of a.
He has a funky track record.
He does have an interesting track record, but he doesn't. Yeah, we won't say anything. No. All right. And then I'm talking about Birkenstock. They are the latest member of the IPO club.
Oh,
so
wow.
we'll talk about Birkenstock. And Tesla announced their vehicle deliveries. That's a quick one. And also Meta are thinking about offering a subscription service, not the blue check mark.
Oh.
We're going one step further.
Wow.
So we'll talk about that in a little bit.
Cool. Well, with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings. And manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors. That's seekingalpha.me/young investors to try Seeking Alpha free. For 7 days, I believe, is the free trial at the moment, but you also get that $50 off coupon, which is available for a limited time. So go check it out if you haven't already. And thanks, as always, to those who use our links when signing up to Seeking Alpha and are supporting what we do here on the podcast.
Definitely. All right, Hamish Hodder.
Let's where do you want to start? Yeah, I don't know. Where should we begin? Take us through this IPO actually. Because
we've
spent a bit of time. Yeah, we spent a bit of time talking about IPOs recently because it really has just gone from no IPOs to all of a sudden like some quite interesting companies have just all of a sudden gone to the market. It was an Instacart I think we spoke about, and I don't know, there was a couple others I'm forgetting about. That's right. Yeah.
So it's been quite interesting. It certainly is not as dead as what it was a couple of years back or a year or so ago.
Yeah.
So yes, things are starting to pick back up. And the next company to join the club is Birkenstock. Do you own a pair of Birkenstocks, Hamish?
I do not. I haven't been sucked into the hype. I know a lot of my friends that have them. I don't get the craze. I haven't been sold that one because I think they're pretty expensive, right? Aren't they like $200? They're pretty expensive.
Yeah, I'm not actually sure. I think they have a range of products, and it depends on kind of what price scale you're at. But yeah, I too have not been sucked into the Birkenstock craze. I actually just don't like how they look.
Yeah, I'm not a big fan. I don't think they'd look good. I'm not
a sandals person, must be said.
Yeah,
I'm a closed toe shoe kind of guy.
Yeah, I also haven't bought shoes in a long time. I have a black pair of high top Converses. And before that pair, I had a black pair of high-top Converses that broke, so I replaced them with a new pair of high-top black Converses.
Yep. I think they're probably the only shoes I've ever seen you wear. What are your other shoes?
I have some Actually, no, that's actually not true. I bought some Brooks running shoes a couple of years ago.
Yeah.
Yeah, so I put some money in Mr. Warren Buffett's pocket. They own Brooks, I think.
Yeah.
But that's pretty much it. I don't think I have some thongs. That's it. That's
right.
It.
There you go.
Yeah.
I'm pretty sure every time I've hung out with you, you're wearing your black Converse.
Yeah. There's a bit of a trend here. I'm not super fashion. One pair of shoes. You're just 20 navy t-shirts.
Navy tees. You're just going the Steve Jobs approach. You've got your look.
I just don't care.
You know your look. Yeah. You're confident in your look. Why change it?
Yeah, I just don't care. Like, I think obviously I get it. Like if you cared about it, then yeah, I understand. You want to have like all different clothes and stuff. I've just given up. A while ago, I just gave up. I was like, I don't care.
You found something that works and you're sticking with it.
Yeah.
I like it, Hamish. It's a good strategy. All right, Birkenstock IPO. Birkenstock, the German premium footwear brand backed by private equity firm L. Catterton, has targeted a fully diluted valuation of about $10 billion in its highly anticipated US initial public offering. L. Catterton? Is that how you say L. Catterton? Catterton.
Yeah, I guess so.
The company plans to sell at least 32 million shares, likely to be priced between $44 and $49 a piece, and raise about $1.58 billion at the top end, as per a filing with the US Securities and Exchange Commission on Monday. L. Catterton will own a roughly 83% stake in the company after the offering. Birkenstock intends to use the proceeds of the IPO to pay down debt.
Interesting.
Yeah.
There you go.
Why not? I mean, sure. I actually checked. As of September 2022, they had short-term debt of 46.6 million euros and long-term debt of 1.9 billion euros. And they had a net profit of 187 million euros and free cash flow of 163 million euros. So I don't know. What do you have any thoughts on that? Fair enough that they want to raise money to pay down debt.
It is kind of unusual. Usually companies don't go public with the intention of paying down debt. Usually it's because they've got some kind of particular growth aspiration. I was actually we'll talk about this with the Bill Ackman story, but in an interview he was actually talking about specifically how it is actually kind of rare that companies go public to pay down debt, and it actually can be quite difficult for them to do that because what are investors kind of getting out of it? What are the specific kind of trajectory of the company? But yeah, interesting to see. I guess we'll wish them all the best.
Yeah, I'll talk to you about why, because you're right. Normally it's like the company has some sort of grand plan, right? And they want to try and raise a whole bunch of money to execute their grand plan. Birkenstock are a little bit more of the Ferrari strategy, which I'll talk about in a minute. But anyway, I had a read through, not an in-depth read through because these documents are dense. What's it called? Their F1 filing, I believe. S1, F1.
S1.
This
S1.
S1? Anyway. I had a read of that, and it says I took out some interesting things because I honestly didn't really know much about Birkenstock. I know what the shape of the shoe is. I get it, they're sandals and stuff, but I didn't actually know that much or how they kind of see their business. So they noted how they started as comfort over style, but recently have gained popularity amongst the fashion industry. They offer unisex products across a broad range of prices, from a retail entry price of 40 euros for their EVA or EVA styles to over 1,600 euros for their high-end collaborations. In a recent consumer survey, approximately 70% of Birkenstock US customers indicated they had purchased at least two pairs of Birkenstocks, with the average Birkenstock US consumer owning 3.6 pairs today. How crazy is that?
That's actually I really didn't know they were that popular. That's crazy. Wow.
Not the average US consumer, the average Birkenstock owner. Yeah.
Oh, true. But even still, that's kind of crazy you would even know. That's
brand
blowing
loyalty.
my mind. 3.6 pairs. I don't think I have 3.3 or 4 pairs of shoes. I definitely don't have 3.6. That would be weird. I have exactly 3.6 pairs of shoes. No, I definitely don't have 3 or 4. I don't know. Do I have 3 or 4? Yeah. Maybe I do. I don't know.
If you count the one that Lucy's hacked in half.
Yeah, exactly.
So there you go. In that same consumer survey, nearly 90% of recent purchases indicated a desire to purchase again, and over 40% of consumers indicated they did not even consider another brand when purchasing their last Birkenstock.
Wow.
How interesting is that? So there is
That's
a bit
crazy.
of a brand forming. There's a bit of a loyalty, I guess, amongst Birkenstock customers. And now over the last few years, their popularity has also grown in that fashion world. They're no longer just like the comfort over style kind of brand. The comfort over style trend is now quite fashionable, and people are kind of jumping on board, as we've seen. In terms of some of their statistics, they've grown revenue from 292 million euros in 2014 to 1.2 billion euros in 2022. So they're tracking at a 20% compound annual growth rate for their revenue since 2014. More recently, they've grown revenue from 728 million euros in 2020 to 962 million in 2021 to 1.2 billion in 2022. So they got a 31% compound annual growth rate over the last 2 years. So things are growing, which is good to see. And adjusted profit has grown from 400 million in 2020 to 774 million euros in 2022. So things are, plugging along. They're growing. Yeah. They're doing a good thing. And they do make money, which is a good thing as well. So well done. But this is the interesting thing, how we were talking about before. Usually a company will do this big IPO for some sort of grand growth initiative. Birkenstock are talking, while I was reading in their S1, that they actually adopt, like I said, more of the Ferrari strategy. And for those that don't know, the Ferrari strategy is to raise prices, but not, if you can, not really release that much more product year after year. So it's more about the exclusivity. It's more of a luxury kind of business model, a luxury brand business model. So they say, we allocate our finite production capacity globally, creating scarcity in the market and facilitating strong control over our brand, as well as predictable, consistent growth. Our strongest, most developed regions are the Americas and Europe, which represented 54 and 36% of revenues in fiscal 2022, respectively. So I wanted to just note down a couple more stats that I was reading out of the filing, just to kind of give you a more of a statistical understanding of how they run their business. So they've got this 2-year revenue compound annual growth rate of 31%. So top line growing at 31% over the last couple of years, 31% annually. Their average selling price has been increasing at 16% annually between 2020 and 2022. However, so 16% increase in price, 31% increase in revenue. The number of units sold has only increased 12% annually between fiscal 2020 and fiscal 2022. So the lowest growth has actually just been in the amount of shoes that they're selling. Yeah. So they're controlling that and creating that more scarcity factor. And they note that their gross profit margin has expanded from 55% in fiscal 2022, now 60% in fiscal 2022. Net profit increasing from 101.3 million euros in 2020 to 187.1 million euros in 2022. So if you kind of just lay out those numbers, it does seem like a business that is trying to develop a more of a brand moat than anything else.
Yeah.
What's your kind of take on it?
Yeah, I mean, you could definitely see that. I'd love to compare their gross margin to maybe similar competitors, because 55, 60%.
Oh, I should have done that. That would have been good.
Is I would imagine it's quite considerably higher than probably some of the. I can't even think of a single competitor, a direct competitor. Maybe there's some big brands that do a bunch of
like
different
footwear brands like Nike and stuff.
I can't think of
direct
an actual
competitor.
Product. Yeah. But 55, 60% gross margins is pretty considerable. So, if they're able to kind of maintain that consistently, and competitors are at more like 30% or 40%, then yeah, that's an indication, obviously, that their brand is able to dictate, much higher prices. So yeah, it's interesting to see.
It is interesting. We've got, as you said before, I just noted down a couple of stats about their customers, kind of to see where they're selling. We've got America 54%, Europe 36%, Asia Pacific, Middle East, Africa. What's that? Such a bad. Is it 10%? Yeah, 10%. Yeah. This is a click. Can you see this chart? This is straight out of their S1, and it's literally in that quality in their filing. It's literally in that quality. Classic. I'm having to squint to see the numbers. It's all pixelated. Gender. They say they're unisex products, but definitely more females than males. There's 72% female to 28% male. Yep. And age, who's wearing them? What age bracket is wearing them? Well, we have the highest percentage, which is, I'm squinting again, millennials. Sorry, millennials at 31%, baby boomers at 30%, and then Gen X at 27% and Gen Z at 12%. So there you go.
I guess that makes sense. Yeah, that is a
Yeah.
funny point though. Like, why are investor presentations and filings? Why are all the graphics so poor, like quality? Like, who's putting this together? Like it's almost harder to have a poor quality graphic than just a normal one. Like, where are you copying this from? Like, like you're
True.
taking like a screenshot of like a screenshot of a screenshot of a screenshot and then putting it in the filing. Like, what? Like, just get the original. Save the original. Anyway.
So true. I do apologize for my kind of lack of clarity in there, because I'm actually having to squint a little bit at some of these numbers just to see. Like baby boomers, I was trying to see if that was 30% or 38%, but I literally can't quite tell.
There's literally no point of us even showing you this graphic because it's so bad.
No, it's so hard to read. Yeah, but I think I got the statistics across.
Anyway, so what was the biggest category there? Baby boomers is the biggest category. Oh,
millennials and baby boomers, pretty much the same.
Yeah, I guess that's probably what I would have guessed.
Yeah.
Interesting.
All right. So another thing I was interested in is how do they think that they will grow? Because obviously they talk about everything in this filing. So they say the global footwear industry is a large and fragmented market. According to Euromonitor, it was estimated to generate approximately 340 billion euros in retail sales in 2022, with the top 5 brands accounting for 20% of the overall footwear market. So yeah, it's not like the cruise line industry where the top 4 players, take up 90-something% of the market. It's a lot more fragmented.
Yeah.
On average, the global footwear market is projected to grow at a compound annual growth rate of 5.1% over the next 5 years, reaching approximately 440 billion euros in sales by 2027. Based on our current market penetration of less than 1%, we believe there is ample white space to continue growing the Birkenstock brand. We expect to capture the market share globally, particularly in Asia Pacific, which is expected to be one of the fastest growing regions in the world at a compound annual growth rate of 5.9% between 2022 and 2027, and where we are meaningfully underpenetrated. So there you go.
Yeah. It's so funny. Like, this is one of the things I dislike about IPOs is like they're all so salesy, and there's like some information that they'll include that's kind of like irrelevant. Like, for them to that's kind of irrelevant. Like, for them to talk about like the whole footwear market is kind of irrelevant because they make like a specific type of shoe that probably fits like a pretty fairly like niche part of the market. Like, they're not gonna someone who's looking to buy running shoes isn't gonna be like, you know what, maybe I'll get some sandals, so like the size of the whole the size of the whole industry is kind of irrelevant because there's big segments of that industry that they will never get those customers because those customers are looking for something else. So it's kind of, and you kind of get this in IPO, like you tend to get this with these prospectors is like, they're trying to like paint the broadest picture of the most optimistic picture they possibly can, like 340 billion euro market. It's like, yeah, but what's the market for your particular customer, basically? And they probably don't provide it because there probably isn't a lot of clarity. Like, they're probably one of the market leaders, so they're kind of driving that market, and it's not super clear how big it is or how big it could be. There's probably a lot of people who've never considered buying sandals, but maybe now that Birkenstocks are making good sandals, they would consider buying them. So that market is probably or potentially expanding. But I always just find it funny. It's like, this is a classic. Even on like, you'll get it on like Shark Tank and stuff. They'll be like, if we just get 1% of this $1 trillion industry, we'll be worth this. It's like, what does that even mean?
Yeah. What's your total addressable market? Well, there's 8.1 billion people and they've all got feet.
Yeah, and they could each buy 30 pairs of shoes. So you do the maths. You do the maths, Mr. Cuban.
We could essentially be the largest company in the world, really, when you think think about it. Yeah. Everyone needs shoes.
Yeah, that is a fact. That is a fact.
Oh dear. All right.
Anyway.
That's pretty much all I've got to talk about for Birkenstock.
Okay.
Let's see. Is there anything else that I was missing? There's just a whole lot of jargon. The only other thing is that They noted that last month Birkenstock said revenue jumped 21% in the 9-month period ended June 30, showing strength against a difficult demand environment for luxury goods as inflation worry consumers temper their spending. But the brand has also found favor amongst fashion aficionados recently after one of its brands was featured in Barbie, where the movie's lead actress Margot Robbie was seen donning a pair of pink Birkenstock. Interesting quote in this article from someone that I was speaking to, which kind of hits the nail on the head. Fashionistas can be fickle, and while Birkenstock may be basking in rays of popularity right now, it's going to have to run fast to keep up in the stylish stakes. Counterfeit goods could also cause the company to lose its footing in the fast-moving fashion environment. But it's so true. Like, there are some fashion brands which truly have a brand moat.
Yeah.
Because they've just been around for decades, if not like some of them hundreds of years.
Yeah.
And they've never gone out of style. But yeah, you think about Crocs, Crocs has gone through this crazy wave where it was
really
super popular.
Yeah.
Yeah. And then everybody thought they were disgusting. And now they're kind of like coming back again.
Yeah.
So they go through these waves.
People
But
can't make up
I
their
wouldn't
mind.
want to be invested in a company like that, where it's like one day it could be super popular, the next it could be hated on,
Yeah, I think it's quite difficult to pick which company is going to maintain their brand over long periods of time. It's a lot easier to just look back and go, oh, okay, that brand of clothing or even like that brand of alcohol has been around for 100 years and it's still just punching sales out year after year after year. That's a lot different than, being in the first couple of years of the company and saying that's the one that's going to be here in 100 years, because most of them don't exist, and I couldn't name them because, well, they don't exist. So yeah.
And it's interesting, like, this company itself has been around for a couple of hundred years, I think. Birkenstock has been around for a couple of hundred years, but like they've only been popular for a few,
Right. That's crazy. That's actually insane. I did not know that, but I guess it makes sense.
Yeah.
I guess people, yeah.
Yeah. But it kind of adds to your point. This is a super old company, but it's only been around for it's only been popular for like the last couple of years. So
interesting.
yeah, interesting.
There you go.
All right, Hamish, that will wrap us up. Good luck to Birkenstock with their IPO. More information when they give us more details.
Yeah, and speaking of how companies go public, Bill Ackman, as I said, has a new IPO investment product for us, which we can talk about because we know, well, some of us know just how well his last big investment product kind of went, but I'll explain all anyway. But billionaire hedge fund manager Bill Ackman announced a new investment product this week called a SPARC, a special purpose acquisition rights company. And if that sounds kind of familiar to you, then that's because it's supposed to be an improved version of a SPAC, which is a special purpose acquisition company. It's supposed to be this new SPARC is supposed to be a better way for companies to list their stocks publicly. So maybe I'll give a bit of context of first of all how companies typically go public, and then what a SPAC is, and then how this SPARC that Bill Ackman has just created is different, and kind of what it means. So typically, if a private company wants to raise capital, they'll do an IPO, like kind of with a Birkenstock we just kind of spoke about. An IPO being an initial public offering, and it's typically a pretty lengthy process. They have to do a bunch of auditing. They have to register with the SEC, which can approve or deny them. They have to apply to a stock exchange to be listed, like the New York Stock Exchange or the NASDAQ, and they have to meet a bunch of requirements, and a lot of the time they don't meet those requirements, so they'll fail and have to go back to the drawing board and do it again. They need to send out a prospectus to potential investors to let them know about a little bit about the company to entice them to invest, which is what Brandon was just going through with Birkenstock. Growth prospects and that sort of thing. They have to get underwritten by a firm, like a bank, which basically sets the terms of the IPO, the price of the shares, the number of shares, and they take their kind of piece of the pie as well. Then the IPO occurs, where some new investors will buy the stock directly from the company, which is called the primary markets. So it's just stock going from the company to the shareholders. And then finally, the stock will go public, and anyone can trade it, which is the secondary market. It's the market that we all trade shares on. So it's typically a really lengthy process. It's very expensive. There's a lot of uncertainty about how much money they'll be able to raise, and at what price the stock will list. We've spoken about some of that uncertainty recently with like Instacart and their valuation, how it's just collapsed over the last few years, and they've been trying to get money. But what company wants to go through all of that? That's boring. Boring. Why do that when you could work with Bill Ackman?
Woo!
You can work with Bill. No, so starting in 2020 or 2021, we started to see this new method for companies to go public, which is called a SPAC. And SPACs have been around, I believe, since the 80s. They've technically been around, but they kind of only recently became really popular. It was like around the pandemic that we in 2021 when we kind of started to see the popularity rise. I'm trying to think of, I'll talk about Bill Ackman's one, but I'm trying to think if there was any others that I can remember specifically, but there was a bunch of them.
Yeah, there was a definite craze. I can't remember like what the biggest ones were.
Yeah,
because honestly, we just don't follow that kind of stuff. It's just not relevant to what we do for our investing. Like,
no,
there were probably some high-profile companies. Maybe I'll look them up.
Yeah. So anyway, what is a SPAC? Well, it stands for Special Purpose Acquisition Company, and it's essentially a shell company whose entire purpose is to take a private company public. So instead of the private company just going public and going through all of that process that I kind of just spoke about, the SPAC itself, which is just an empty company, it's just a shell company, does an IPO itself. It raises some capital. And then essentially that SPAC is a publicly traded company that has a bank account with some money in it. And that's it. It's literally just a company with a bank account with some money in it, has no business operations. But then that company can just buy a private company. It can acquire or merge with a private company. And by doing that, it takes that private company public without having to go through all of the regulatory process. It's the SPAC that, the shell company that goes public and then just kind of just yoinks the private company into the public markets. And Bill Ackman made one of these SPACs in 2021 called Pershing Square Tontine Holdings. I think we probably spoke about it on maybe a couple of episodes. So he made the SPAC and raised $4 billion for investors. And then he tried to find a private company to buy for $4 billion or to buy some shares for $4 billion. So basically the SPAC investors were just betting that Ackman could find a good deal. So if you invested in the SPAC, you had no idea what stock they were or what company you were actually going to end up owning. It was kind of like, I like Bill Ackman. I trust his investing skills. I'll give him some money basically, and he's going to pick a company to find. And there was a bunch of,
and what I was trying to remember what companies were out there at the time that Bill Ackman was looking to potentially acquire. It wasn't like Airbnb one of them?
Yeah,
Am I
think,
crazy in thinking that?
Yeah, there was Airbnb,
remember.
which Airbnb I think ended up going public themselves. I'm pretty sure they're public.
Yeah,
now. But I think Airbnb was one of them. Stripe, which is kind of a online payment processor.
Oh, that's right.
They were one.
Yeah,
Even Bloomberg was potentially a target.
And
then in the end, they actually did start to make moves on a deal with Universal Music Group, which they actually, so they had kind of a deal on the table, but the deal ultimately fell through. So in the end, the SPAC just failed. So the $4 billion was returned to investors. So investors didn't lose anything unless you bought the Pershing Square Tontine Holdings shares on the public market, then potentially you lost. But the original investors got all of their money back. But it was a bit of a failure. Nothing really came of it. And then everything was kind of quiet for a while until this week, where Bill is back and he's got a new product that's called a SPARC.
Get around the SPARC. No. It's not a SPAC. It's no. Don't forget about the failure. No.
Yeah, he did an interview on CNBC, and that's exactly how it started, because the interviewer was like, SPACs have kind of got a bad reputation for not being that great, because there was a couple other
really?
that kind of didn't do very well for investors afterwards. And Ackman was like, no. This isn't a SPAC. This is a SPARC. Completely different. Completely different.
That's funny.
It's like that Scooby-Doo meme where like they lift the lift the mask off,
Yeah.
and it's just a SPAC underneath. Hang on a second. So no, but it is slightly different to a SPAC, but it's pretty much the same. But instead of raising $4 billion, for example, and hoping to find a private company to buy, they would find a private company to buy first and then raise money. So at least the people investing in the SPAC or the SPARC will kind of know which company they're going to ultimately invest in. So that's kind of the major difference. It doesn't mean that the deal will be finished before they invest in it. It's just that the deal will kind of be announced. So they'll say, hey, this is the company we're targeting. This is how we're trying to raise money, what we're raising money for.
Yeah, there you go.
And so that why would a company want to do a SPARC instead of an IPO? Well, when a company does an IPO, they basically have as I kind of mentioned, they have no idea how much money they're going to be able to raise and at what valuation. They're kind of just guessing and hoping. Whereas in a SPARC, essentially, Bill Ackman will do some due diligence and he basically sets the price. He basically says, this is how much money they're going to raise and this is going to be the stock price. So it's kind of fixed in a way. It's like instead of letting the market value the company initially, Bill Ackman is going to value the company. and whether that's a good thing is whether you trust Bill Ackman's valuation process and his due diligence. So there you go.
Right. Okay. There you go. So he's going to kind of find a company, line them up, and say, do his due diligence, think about what he might want to acquire them for. He's going to set up this SPARC, and then he's going to go and get investors to raise that amount of money.
Yep, exactly. Okay. So he'll put. So he runs obviously he runs his big Pershing Square investment fund. So he'll put capital in himself. And then I believe the people first in line to be investors in this are all the people who initially invested in the SPAC from 2 years ago. He's kind of giving them preference to get first in line for this new this new vehicle.
But the difference is that he's figured it out already, and he almost takes that to the investors to say, look, this is what I want to do. This is how much I want to pay. Would you like to be in? And then they go yes or no from there.
Yeah.
As opposed to the other way around, which is like, hey, give me this amount of money and then I'll go and try and find something.
Yeah, exactly.
Makes sense.
So I guess it's probably a little bit better. It's still it's
for sure.
It's still kind of an odd way to invest. Like I think I said this last time we were talking about the SPACs. If Warren Buffett did one of these, like that'd be pretty cool to be involved because it's like you're kind of giving money to an investor that you trust their process. I don't know if I'd trust Bill Ackman's process, but like if Warren Buffett would never do that, obviously. But if he did, then that's probably the only person I would actually be like, yeah, you know what, take some money, find a deal, and do it that way. But yeah. And then in terms of which company is going to be acquired. We don't know yet. This has kind of just been newly announced, but X.com, formerly Twitter, actually asked Ackman if they would consider them for the deal. So we may actually see Mr. Elon Musk's Twitter company publicly traded again pretty soon.
What?
Yeah, how's that for a plot twist?
What?
Yeah. So at this stage, all that they've done is ask Ackman to look at it, and he said he said on the interview with CNBC that he will consider the deal. But it'll just depend whether Ackman can raise enough money at a valuation that Elon Musk would be happy with, and whether that actually makes sense. Whether X needs to actually do that. Wow. Yeah, that would be quite a plot twist to see them publicly traded again. But it would be kind of funny to see because then we'd be able to work out how badly Elon Musk, how much he overpaid.
Yeah,
if they go public again for like $15 billion or something, and he paid.
That's so interesting. Does that just tell us that Elon Musk kind of wants out of Twitter?
I don't know. Yeah, I'm not sure. I mean, I guess the way it would happen would be is if they really needed money, like if they had no other choice. Which I think they've been struggling for a little while to kind of keep the boat floating.
Yeah, keep the boat afloat.
Yeah.
Yeah, that's hectic.
I guess that's the way it would happen. But yeah.
So interesting, because that kind of flies in the face of everything that Elon Musk wanted to do with Twitter. Like, he wanted to get it off the public markets, not have to talk to, do earnings calls and talk to shareholders all the time, and, he could basically turn it into what he wanted to turn it into. He could take a short-term hit on the advertising front while he built out other monetization things, whereas, if he had it public, he would have to try and argue with shareholders that would be getting annoyed that their stock was getting less valuable. So that would be, I think, quite interesting if Twitter ended up getting lumped into this SPARC, because I think that would indicate that Mr. Elon Musk is kind of backtracking and 180ing the hell out of his decision.
Yeah.
But yes, what you say is true. Yeah, hectic.
Yeah. So there you go. That's what Bill Ackman's doing. He's been cooking up a new product for us.
Good luck, Bill.
So we'll see. Luck. We'll see what he finds. Maybe it's X.com. Maybe it's something else.
Look, we at the Young Investors, we'll consider it. We'll consider it. Yeah, for our fund. Young Investors Fund. Yeah, we'll consider buying in. Yeah. Not sure yet. All right, Hamish, what should we talk about next?
I don't know. What have you got?
I'll go through Tesla deliveries. This is just a quick one. A couple of interesting points. We didn't talk about this at the time. Did you see the new Model 3?
No, I did not.
No,
there's a new Model 3.
I've put a little picture in here for you to browse your eyes over. Yeah, so while you have a look at that, I'll talk about the deliveries. So in Q3. In Q3, they had total production of 430,488 vehicles. 430,000 vehicles. Hectic. Crazy. And deliveries of 435,000. So roughly the same production and deliveries. How does that stack up versus last quarter? Last quarter, they both produced and delivered more. So they've had a bit of a slowdown. So last quarter they produced 479,000 vehicles versus the 430,000, and they delivered 466,000 versus the 435 that they just reported. So a bit of a slowdown in production and deliveries. However, nothing to get too concerned about. People might be saying, macroeconomic environment, look, vehicles are slowing down. They did say that Q3 was going to be softer, and the main reason for that was that they were downing tools to do a whole bunch of factory upgrades. So to be expected, everybody, to be expected, because they were retooling the factories to build this new Model 3. The new version of the Model 3. It's obviously a slightly different car. It's got slightly different componentry, a slightly different look. They need to update the factories to be able to produce the new version of the Model 3. So they put their tools down, they suffered a little bit, tinkered away, upgraded the factory, and now here we are.
Wow.
But yeah,
interesting.
New version of the Model 3. Yeah.
Right. So do they not think that any macro is involved in the decline? Or?
They don't actually talk in depth on the delivery. They literally just in this because it's straight after the end of the quarter. I'm sure they will talk about that when they do their earnings. But for this release, it's literally just this is our production, this is our vehicle deliveries, and then after that, it's just all other people's analysis and opinion.
Okay.
So yeah, they haven't actually spoken about that yet.
Gotcha.
But
cool.
we shall see.
There you go.
Yeah, but don't want to hang on this for too long. There's not really that much to talk about, other than if you haven't seen the new version of the Model 3, go and have a look, because I reckon it looks better. Like, I've got one of the old Model 3s, the 2021s, with the more bubbly looking Porsche-esque kind of headlights. But I actually quite like this new version. The front end of this version, I think, looks better than my car.
Yeah, I'm a fan. I like how the Model 3 looks. I think both of them look pretty good.
Yeah.
I don't know. They're reasonably good. I'm like
it's all subjective, isn't it?
Yeah, I'm like super picky when it comes to like how cars look.
I know you are.
I hate how most cars look.
Do you?
But I think I've done a good job. Yeah. I like older cars. I like boxier cars. Like I hated how cars evolved to be like all really like smooth edges and everything. That I just don't like. They,
Right. Okay.
I've said this before. I've said it again. When electric car companies start making cars like in 60s and 80s design, but with tech inside of them, they will make so much money. It's not funny. Like make like a like a 1969 Ford Mustang that's like electric and has like Apple AirPlay in it and everything.
Yeah.
And that
that'd
will
be
sell
sick.
like hotcakes.
It will actually. And the other thing I forgot to mention, Hamish, is that Tesla have recently redesigned the Model S as well.
Oh, okay.
I've put in a new photo of the Model S. What do you think of that?
I see nothing.
Oh, you can't see it.
No, it's coming. It's coming.
That's
That's
Do you like
beautiful. That's exactly what I wanted. Yeah. That's
I've just
great.
posted in. Do you know what model that is? Porsche.
know,
Hamish is a
GT3?
big Porsche fan.
Is it a GT3?
Probably.
I don't know.
I have no idea. I think so.
Yeah, there you go.
Yeah, I got no idea. But there you go. Yeah, you would love it if the Model S looked like a Porsche.
Yeah, maybe one day.
Would you get the Taycan or Taycan?
Yeah.
That'd be pretty cool.
If it wasn't insanely
the
expensive.
Porsche EV.
Yeah. If it wasn't just a money pit, then yeah.
Yeah. What's your favorite Porsche model?
I like a Carrera S. Or just a Carrera.
Carrera S.
That's just their classic 911.
Yeah. Nice. Very nice. All right, cool. Moving on, Hamish. Let's talk about Sam Bankman-Fried before we end up talking about cars for the whole rest of the podcast.
Yes. Let's talk about Mr. SBF. I'm gonna be careful. I'm gonna do this again. I'm gonna call it what's the other abbreviation that we've been using? SVB.
Oh, SVB.
Yeah, SVB.
Yeah, Silicon Valley Bank.
So confusing to SBF.
Yeah.
So founder of FTX.
SBF of FTX.
So many abbreviations. So bad. Founder of FTX, cryptocurrency exchange, which of course collapsed last year in pretty fantastic fashion. Is facing his criminal trial, which is actually kind of interesting. They turned that around pretty quick for him. It's been like it was last year, right? It was like the end of last year, I think. Whereas then you had like Elizabeth Holmes, who took like almost a decade from when the company collapsed to actually get charged. So they've got him on trial. He's been charged with 7 total counts, including securities fraud, wire fraud, and conspiracy to launder money. And kind of at the heart of this, as some of you might remember, is he's basically accused of co-mingling funds with another company that he owned, Alameda Research, which was this kind of investment crypto fund that he says he wasn't running, that he kind of palmed off to some of his friends to run. But that fund ultimately lost billions of dollars, and it was found that there was co-mingling of funds, and people who just thought they had money deposited in FTX just in an exchange with no risk, basically, lost all of their money. There's likely to be kind of less emphasis on whether the co-mingling actually happened. It's pretty defined that it did happen, but more about whether he did it intentionally or by mistake. That's kind of the whole the whole story around whether he actually committed fraud. Did he just accidentally allow funds to be used in a manner that he promised he wouldn't? Was it just an accident? Like he claimed, did he just mislabel accounts and that sort of thing? Was it just poor account? Was it just a mistake? Which, was he just he just made a bunch of mistakes running the business? Or did he purposefully move FTX customer deposits to make trades, to make money for his own personal benefit? That's really where this trial will sit. And that's going to be
that's what all these fraud cases come down to, like Elizabeth Holmes as well. It's like, what's the intention? Yeah. It's like, sure, you can have a dumb moment, you can do bad things, and you still get punished.
Yes.
But what's more important is what was your intent? Yeah. If your intent was, malicious, then the punishment will be worse than if the intent was, or if there was no intent to be malicious and you just had a bad moment. You did something dumb. You still get punished, obviously, but what is the intent? What was Sam Bankman-Fried's intent? Anyway, sorry, Hamish. Yeah,
you're exactly right. That's the most important point when it comes to these criminal fraud charges, because the consequences are pretty high. There's, potentially decades of prison on the line. So that's what they have to prove. So anyway, so this trial started a couple of days ago. Day one was all about kind of finalizing the jury. And there was kind of some funny moments that came up. So they basically had 50 jurors who made it through questioning by the judge. The judge kind of sits down and questions them in front of both of the teams. And then from those 50, 18 jurors are selected, 12 which are on the jury, and 6 alternatives in case some of the jurors have to leave be excused for some reason. And then basically, how do those 18 jurors get selected? Well, the prosecutor and the defense both get they get to kind of pick from the pool. And then they also get a number of vetoes. So they can, if the prosecutor picks a person to be on the jury, then the defense can kind of veto that person. It's kind of like picking football teams. And it's pretty important because you get such a wide variety of potential people on the jury. And it doesn't have to be a unanimous decision. This isn't a murder trial. So 7 out of 12 saying, yes, he did it, will decide it. So it's 7 individual people that they're picking. So, you know, how these people are involved in crypto or not, and what they understand and what they don't understand can make a big difference in ultimately how this case is decided. So the judge has to kind of question all of the jurors pretty intensely. Quite a few of the 50 jurors said that they had followed the FTX case closely. Some said that they'd been reading Wall Street Journal. Others said that they kind of watched this 60-minute interview with Sam Bankman-Fried in it. So some had said that they'd actually been following the case, and that kind of makes a difference. Some said that they had a loved one who invested in crypto. There was actually one man who told the judge that his brother was nearly financially ruined by bad investments in crypto. So we don't know. I don't actually know if that guy's on the jury or not, but I can pretty confidently say the defense probably vetoed that guy.
Yeah.
Like, it was probably pretty likely that the prosecution was like, yep, get the guy who got financially ruined by cryptocurrency on the jury. And then the defense was probably like, yeah, let's not have that guy there. So that's kind of, I mean, that's like the stakes that are, you know, here. I mean, you could get some people on there that have been very affected by either FTX, well, not FTX directly, because that would be a conflict, but by crypto in some negative capacity and have some negative feelings towards SPF. Another juror said that they had concerns because they didn't understand crypto even after their son tried to explain the concept to them. And that's the other thing. It's like the jury are just people from the public. So there's no necessity to actually understand what is happening, like how all of this works. And that's, you know, the role of the two parties to kind of try and help the jury understand what is happening.
Yeah,
so that
very
was
interesting.
So that was day one. Day two, the jury was finalized, and they both kind of gave opening statements. Thane Wren, the assistant U.S. attorney of the South District of New York, gave a statement. He was quoted saying, "He had wealth, he had power, he had influence, but all of that was built on lies." Part of the defense's opening statement said, Sam didn't defraud anyone. Sam did not steal from anyone. He did not intend to steal from anyone. So there's kind of moments of the...
what they would say.
That is exactly what you would say, yeah. If you were defending someone on trial for fraud, he didn't commit it.
Yep. Yeah.
The only thing I wish is more of these trials were like recorded, because then we could get the full picture of what was happening in the court, but we kind of only get statements from journalists that are kind of writing down notes, unfortunately. But from here, witnesses are going to be and have been testifying over the last couple of days for the prosecution. There was a commodities trader who lost $100,000 in FTX who testified. Sam's old roommate from college who worked with Sam and then resigned when he found out that Alameda was using FTX's deposits. He's going to testify. And then probably the star witness is going to be Sam's former girlfriend, Caroline Ellison, will testify. She was running Alameda Research, but claims that she was being directed by Sam, which is kind of one of the big contentions was Sam running both of the firms, or was he keeping his kind of fingers out of Alameda Research and only running FTX? So there you go.
Yeah.
That's pretty much all we know.
We shall see. We shall see.
Yeah.
Honestly, I don't like it. I don't know how this is gonna play out, but I'm very, very interested to see what happens.
Yeah.
Very, very interested.
Yeah. Yeah, I don't know. Some people might find it boring, but I find it interesting going into the weeds of some of this stuff.
Yeah. And it's just so interesting just watching the whole cryptoverse just fall apart over the last couple of years.
Yeah.
And just the amount of fraud and deception that we've seen uncovered is just bonkers. But we can't say that yet because we'll have to wait until the end.
Yeah, allegedly.
Allegedly. Yeah, alleged fraud. Yeah, exactly.
Yeah.
All right, Hamish, is that all we got on SBF?
That's it.
SVB.
SVB.
All right, I'm going to quickly fly through this Meta subscription service, and then we'll do one Q&A question and get out of here.
Yep.
This is a quick one. I just saw this pop up. Meta is considering charging its European users nearly $14 a month for an ad-free version of Instagram if they do not agree to let the company use their personal data for targeted ads, according to a report of the. Imagine that you're opting out of personalized ads, and then you get another pop-up saying, okay, now that you've opted out, it now costs $14 a month.
Yeah, interesting.
That's essentially what they're trying to do. The proposal, which would cost users around $14 a month on mobile devices and as much as $17 a month on desktop, is Meta's attempt to navigate strict privacy rules in the EU. The rules will require Meta to get users' consent in order to show them targeted ads, which would likely have an adverse impact on the company's advertising revenue. That's what we've seen. That's the trend, isn't it? That's the trend at the moment, is that you can now opt out or you have to opt in for personalized ads.
Yeah.
Meta has spoken with digital competition regulators in Brussels, privacy regulators in Ireland, and other EU privacy regulators about its proposal, according to the report. The company has reportedly named the plan Subscription No Ads, or SNA, and it wants to start rolling it out in the coming months. It is not clear whether regulators believe Meta's proposal is a sufficient workaround, according to the report, and they may ask the company to propose a cheaper offering. Quote, Meta believes in the value of free services which are supported by personalized ads. However, we continue to explore options to ensure we comply with evolving regulatory requirements. We have nothing further to share at this time, a Meta spokesperson told CNBC on Tuesday. So there you go. They could be making Meta or Instagram quite expensive if you choose not to accept personalized ads.
Yeah, well, it was kind of an insane rule that the EU is pushing through to say that not only do you have to ask customers about personalized ads, but they said you have to offer EU users a version of Instagram or Facebook that doesn't have personalized ads, which is their entire business model. So that's why they have to offer. They're hoping that this is good enough that they can say, well, here's a version without personalized ads, but it's going to cost you. If that's not good enough, that's just an insane law. Like, that's just ridiculous because that is their business model. It's like you can't force a business to provide a service.
We will crush you.
But you can't charge a subscription and you can't run ads. It's like, well, then it's not a business. It was kind of crazy. We spoke about this, I think, a few months ago when this law kind of, maybe at the beginning of the year, when this kind of law took place. But it's kind of an insane law when you really think about it, because no one's really forcing you to use Facebook or Instagram. That's like that's really you opting in. It's like you want to be on these platforms. I do like the idea that you could pay for no ads, like YouTube Premium, for example, is kind of the same thing. I think that makes sense, but yeah, I don't know. I think most people are not too mad about getting some personalized ads. I don't know.
No. If anything, I prefer it because it means the ads that I inevitably see have some sort of relevance to who I am. I'm not just seeing just random garbage that I don't care about.
Yeah.
It's like there was a time where I was getting ads for a device that girls wear around their waist to help them with period pain.
Oh, yeah.
I'm like...
Yeah, I get those ads too.
Do you?
Yeah,
I'm like,
I think because like,
why am I seeing this?
Yeah, but I think they're like targeting like men to get it for your girlfriend. I think that's like their
they're targeting the boy. All right, okay. Because I just saw that and I was like, What? Like, why are you targeting me? That makes more sense.
Yeah.
I was like, I'm never going to buy that in a million years. Why? Because I don't get period pain. Surprise, surprise. Anyway, but no, that does make sense to target the boyfriends. And we'd be like, here you are. Oh, you got me hard works.
Yeah, exactly.
Love you. All right, fantastic. Good luck, Meta. Hopefully the EU comes to their senses. All right, should we do one Q&A question then bounce?
Let's do
it. Also, if you have a Q&A question, head to the most recent version of the podcast over on YouTube and drop us a comment and we will chuck it in for a future episode. You can also ask in the Spotify question box.
All right. Do you actually need amazing management if you first and foremost look for businesses, as Warren and Charlie would say, can be run by idiots?
Oh, yeah, that's a good question, actually. I would say, yes, you definitely need good management, because in order for you to get a good return, you need a great business and you need that business to be run by great managers, because the great managers will get the most out of the good business. So that's really, really important. Fundamental pillar is to have a great business with competitive advantage and to have great management that run with skill and integrity. That's really paramount. You do want both. It is very handy, however, if you do have that business that can be run by an idiot. You don't want it to be run by an idiot, but that it could be run by an idiot, because eventually, as Warren Buffett says, eventually it will be run by an idiot.
Yeah.
So if you can have a business model that will just by itself hold up okay, if it's run by a poor manager, that is a very nice cushion to have, because eventually people find out that this is a bad manager, they'll get rid of him and get someone else in, but the company will probably survive because it's a robust business model. But it is definitely a requirement to have a great business and it be run by a great manager, because a good business run by a poor manager it might survive, but it probably won't make you any money. It just won't go bust. But really, you want a great manager to get the most out of a good business.
Yeah.
If that makes sense.
Yeah, I don't think there's anything I could add to that. That's pretty much that's pretty much it.
I just went on a tear there. I was just on it there.
Yeah, you're right. The end of that quote is can be run by idiots, because one day it probably will be. Especially if you're owning a company for a very long period of time, there's likely going to be changes in management. So yeah, I think assessing management is important, but yeah, if the company can be run by an idiot, then it's just another layer of protection. If you make a mistake with management, then you're less likely to be affected. If management changes and then the new guy who comes in isn't as good, then you're less likely to be affected. It's just kind of a protective layer, but yeah, having that solid management on top is certainly an important element.
Yep. Awesome. All right, guys, that will just about wrap things up for today. Keep sending in your questions. Sorry, we always think that, we're going to get to a few more questions today, and then we just... I don't know. Where does the time go? It goes so quickly. Yeah, maybe we ramble. But anyway, guys, thanks very much for tuning in. As always, keep sending in your questions, any content ideas, anything like that. Just let us know. Thanks always to Seeking Alpha for sponsoring the podcast. Thanks, Hamish, for joining me as always. Hope you have a good week, mate.
You too.
Hope you stay amongst the living. Stay happy. Stay healthy. That's the most important thing.
That's great.
You like that one? I can't remember where I heard that from, but I love it. Stay amongst the living. Anyway, yes, stay healthy, and we'll see you guys next week.
See you guys.